If you make over $400,000 per year and you've made the decision that you want to get into short-term rentals with an Airbnb for the bonus depreciation, the tax savings, and the cash flow, now you're probably thinking, what can I do to reduce my total down payment? Or what can I do to reduce my closing costs? That means you're probably going to pursue some combination of creative financing. So I'm going to go over the 3 most common types that you'll see on deals like this. So let's dive in. So there are 3 common types of creative finance, and we're going to start with seller finance because this is the easiest and most relatable to understand. So typically when you buy a primary residence, when you buy an investment property, you're typically getting what's called a private loan or a commercial loan, depending upon the property type and the type of loan that you're getting. So you're likely going to get what's called a promissory note between you and your bank or your mortgage company. Now, instead of the bank funding the debt, the seller is the person that you hold a promissory note with. So what does that mean? Well, the loan terms are pretty much still going to be almost identical. They're typically amortized over 30 years. There's an interest rate, but the difference is this time around, we as a buyer are able to negotiate typically a lower than conventional interest rate because we are negotiating on a lot of different variables on the property. So instead of us needing to simply accept some sort of a fixed rate that's determined by a bank or another third party, we can actually go and negotiate with the seller. Some other important notes on this type of a transaction. There are a combination of elements that go into the acquisition of an asset like this. You have 2 major buckets. You have price and you have terms. Now, price is the purchase price associated with the asset. In this scenario, it's a home or a property. And the terms are the mechanics of how the purchase is structured. So terms includes things like down payment, includes things like interest rate, it includes things like amortization period, which is the amount of years that a loan is amortized over. There might be seller financing. There might be other elements of a transaction like this. There might be a balloon payment date, which I'll talk about in another video. But basically what this means is you cannot win on both of these. You have to win on one. So there's really no scenario where a seller would allow a buyer to win on their ideal price and their ideal set of terms. What we as buyers recognize is we look at a calculation called internal rate of return and cash on cash return. I would say these are every investor's 2 major metrics that they measure when they're acquiring investment properties. So what we're willing to do in almost every scenario is we know that every seller is married to a price. Every seller who buys a home and then plans on selling it 3, 5, 10, 15, 20 years into the future is obsessed with this idea that they bought an asset, it went up in price or went up in value over time, they paid down debt, and they are very, very married to this idea of price. Well, what we're very willing to do is we're allowing and even encouraging sellers to give us the price that they want because we can pretty much give them a price that nobody else will be able to. In exchange for that, we want to win on terms. And in 99% of scenarios, if you structure your down payment, your interest rate, your amortization period, balloon payment date, all these other items that go into defining the terms associated with the purchase of a home, you will win big. So what we notice is a subject to transaction is actually very, very similar. It has very similar mechanics in the sense that there's a low down payment, typically a very low interest rate. And then what does that mean? Low down payment, low monthly payments, very, very good deal for cash on cash and internal rate of return. A subject to transaction is technically labeled as a non-qualified loan assumption. This states that the debt associated with the asset. So let's say, for example, a home that was purchased in 2021 was purchased by John, and John holds this mortgage, let's just say for this example, in his personal name. So John Doe makes monthly payments. Now, John is selling this home to, let's say, Dave, okay? Now, the debt stays attached to John's name, right? So when this property is deeded over to Dave, Dave is now the owner of this home, but Dave makes the monthly payments on John's debt every single month. So for further detail, this is specifically referred to when a first position note or a first position loan, so for example, a mortgage. In this case, let's say that John had some sort of a loan product just for really easy math. Let's say he put $100,000 down on a $1 million home. There was $900,000 in debt. And in the last 3 years, John has paid down maybe close to $40,000 of that debt, that principal amount. That is probably wildly off, but let's just use that as an example. The remainder amount of debt is $860,000. Dave is now responsible for making that debt payment. John still holds the debt in his name. The property is deeded over to Dave, but Dave is now responsible for somehow making those monthly payments on this debt in one of two ways. The first and most typical one is going to be through what is called a servicing company. A servicing company is basically a third-party intermediary bank that makes the responsibility of making those monthly debt payments every single month. And Dave, instead of wiring ACH transfers to, let's say, the mortgage company or the login portals into John's account, John basically gives the account logins to the servicing company. They make the monthly payments on the debt, and Dave makes payments to the servicing company. The other scenario is where Dave literally just gets those login portal credentials, attaches his bank info, so just changes the account name, or the account number rather, and the routing number, and he just makes those payments directly. So in either scenario, what's important to note, Dave owns the property at close. So in this crazy example where I've drawn so much, the property is deeded over to Dave, right? So the debt still stays in John's name. The property is now owned by Dave, but Dave is the one who is sending the monthly payments on the debt, either directly with himself, or he uses the money bags, the bank, intermediary bank called a servicing company, to make those payments. Now, a hybrid is literally a combination of those two, right? So a hybrid deal, for example, is going to make more sense once I define what are the typical scenarios that a seller is in that makes it more appropriate for either deal. But what you'll quickly recognize is very few people own their homes entirely in cash. And a true seller finance deal would be one in which a seller purely owns a home entirely in cash. Now, this is certainly the case. If somebody's owned a home for over 15, 20 years, it might have gone up considerably in value, and there might be very, very little debt that is still owed on the home. Most loans are amortized over 15 to 30 years. There are some sellers who just choose to pay off the debt at an accelerated rate. But in reality, it's typically going to be a combination of those two. And I will give you an example of that in just a minute here. So let's talk about the scenarios. What would be a scenario where a seller, for example, would want to exit the home on those terms? Or what would be the mechanics around what is the purchase price, what is the equity of the home that dictates which scenario is going to be more likely? So a subject to transaction is going to be much more typical, and a hybrid of the subject to and seller finance element is probably going to be the most typical because of the equity range. So let's start with there and let's go through the difference on each of these. A typical scenario for a subject to transaction is very low equity. The typical equity scenario for a seller finance transaction is going to be very, very high equity, literally meaning the seller owns the home entirely in, or almost entirely in cash. And then a hybrid is somewhere in between. So what kind of dictates this? Well, let's go through an example. Let's go through an example where a seller bought a home in the past 1 to 4 years. As you can imagine, the seller probably used some sort of a loan product, and regardless of the amount that they put down, there hasn't been much that's happened in the last 12 months, 36 months, 48 months for the home to go up some crazy amount in value. So what does that mean? That means that their equity position right now is still going to be very, very low. So when they bought the home, let's say, for example, they used an FHA loan or just any other loan product where they were able to put 5, 10% down, or they had, some other scenario where they were able to just do very, very low money down. Well, the scenario that they're in is because their equity is so low, they're really not in a position to negotiate much, because if they were to get a conventional buyer and somebody were to pay them a cash equivalent with like a conventional loan product for their home, they would be required to write a check in some scenarios after their proceeds that exceeds the total amount of proceeds that they received on the home. So let's use an example on this. Let's say that a homeowner has under $50,000 in equity, or let's say their home is worth exactly $1 million right now. They bought it for $1 million 5 years ago. Whatever amount that they put down, let's say they put $25K down, they've paid off $25,000 in debt. So they have a $50K equity position. So let's just squeeze this in right here. So let's say they've got 50K equity, okay? Well, let's say they go find a conventional buyer, somebody who's going to go to a bank, get a loan product. They're going to give them $1 million. Well, it sounds amazing. They're getting $1 million for this home. Well, they literally still have $950,000 of debt on the home, and they're going to have to pay off closing costs, and they're going to have to pay commission to the buyer's agents. So in this example, let's run through this. And this is why most sellers are actually open to subject to homes, is because they really have no other option. We can find these on market or off market. We let the seller know, hey, if you get $1 million today, well, you're going to have to pay 2 seller's agents commissions. Let's say it's 2.5% for each agent. One to the buyer's agent, one to the seller's agent. Well, right now, they're going to have to pay much more than the, So right now, this is half of the equation. They will also have their own closing costs. So let's say they have to cover 50% of the closing costs, or whatever state that they're in. It's structured that they're going to have to pay, let's just say $8,000 in closing costs. So what do they owe? Well, they have to pay off all their debt at close, $950K. They have to pay each of the buyer and listing agents commissions, $50K, and they have to pay this closing cost item, which is $8K. Well, when they close on this home, their debt or their debit amount on that settlement statement will literally be $1,008,000. And what was their proceeds in? $1 million. So when I go through this example and say they might need to write a check just to sell the home, that is the example on the conventional buyer side. So if we're going to sell this home or we're going to buy this home, we might talk to the seller and say, hey, maybe we can hit you up once your listing expires, or maybe you can exit your relationship with your listing agent in a way that's appropriate, on a timeline that's appropriate, because you are likely going to need to sell the home as a FSBO, a for sale by owner. And also, what you would probably rather do is, instead of this scenario where even if you avoid the $50,000 in commission to your buyer's agent, listing agent, what they might also want to do is just sell this off market and then recognize, hey, we can actually just write you an equity check. You can actually make money exiting this deal. You can walk away. We have to keep the debt in your name because it's at such a low interest rate that it's more appealing for our buyer to take over this home with a lower interest rate and therefore lower monthly payments than something like 7%, 7.25% interest rate right now. So that is the scenario. And the other reasons why a seller might be distressed, in addition to what is already pretty distressful, they already have very low equity in the home. Why would they want to be selling so quickly? These are going to be the top 2 or 3 buckets. Number 1, literally just moving. I know it's a remote work environment, but there are literally hundreds of millions of people who still work every single year, and they show up to a physical location, and their job requires that. And if they move to another state, well, they don't really have any utility for the home, especially if they're not going to turn it into a rental and they're not super affluent. The second, and I believe this is an exceptionally common one as well, unfortunately, there are sellers who are going through a divorce. So during that scenario, very, very stressful. A lot of times sellers are looking to move really, really fast. If somebody can help solve their problems, which is, I want to exit this home as quickly as possible. I want a buyer who can perform and close in the next 2 to 3 weeks instead of 30 to 60 days, which might be a more traditional timeline with conventional loan products, where a bank is involved. There's QC and QA, quality control, quality assurance, where a bank or a lender is literally validating everything on the buyer's side. Those transactions have a failure rate because some buyers technically can't qualify for the final loan products that they're granted, and then they pull out of those deals. Well, if we're a subject to buyer and we say, for specifically the person who's going through a divorce, dude, we can close on this home in like 20 days. During the next 1 to 2 days after they speak with their divorce attorney or a real estate attorney, it becomes very, very clear this is the quickest exit for them, and that is typically what people going through divorce want. The third scenario is somebody has already been running this home as an investment property, and they just have not been doing well. It's not necessarily indicative that the home isn't in a great market or that the home isn't a great property to run as a short-term rental in an otherwise good market. It literally 90% of the time boils down to this. They were managing the property themselves. The majority of people who are doing this on their own are going to be completely terrible business owners, bad with pricing management, bad with guest management, bad with everything as it relates to getting the highest occupancy, the highest booking rate, and the highest price per night for their listing. And then because they're so distressed due to the combination of the above, they're very, very happy to explore any scenario where they get more equity and don't need to write an equity check, and they can close super, super fast because it's already a super stressful scenario. When we talk about seller finance, these types of sellers are typically on the other end of the spectrum, namely because they are going to be, as you can see here, exceptionally affluent, exceptionally well-to-do, exceptionally, I don't need much today money. I don't want to lose today money, which is a product of selling the home, having capital gains tax, this thing I'll talk about here in a second, and then having to lose 21% of their proceeds to capital gains tax. And then plus, depending upon the state they live in, depending upon the county that they live in, and depending upon their age and how long they have held the property, there are other taxes that they incur. So that 21% number jumps up even higher. And once you show them the math, if they don't already recognize this, they do start to recognize, I kind of need to take a little bit of today money and then come up with a structure so that in a few years, if I take a balloon payment and I take more money at a later date, I have some sort of mechanism to shield the gains or some sort of charitable foundation that I'm moving the property to, and then I can take gains, take them tax-free, and then figure out how to come out of this on their own with a structure that actually makes sense. So the elements of, they are very close to retirement or already retired, exceptionally wealthy and well-to-do. And again, if somebody owns a, let's say, $750,000 home and they own it almost entirely in cash, they're pretty well-to-do, right? Like that person is almost a millionaire on paper just with this one asset. So much so that they might not need any additional income for the rest of their life or in the immediate future to sustain their current lifestyle or future lifestyle. They're also typically not in a hurry to sell the home. Now, this one is interesting. We end up closing on a lot of homes that are seller finance terms, and sometimes clients see that the home has been on the market for 60 days, 120 days, 180 days. There are even scenarios where a Zillow listing shows that the property has been on market for over 196 days, even though most typically expire at the 180-day mark. And they're like, well, doesn't this home kind of scream that nobody wants it? What I would argue is you need to have a dialogue with the seller in almost any market because they simply can have the home listed and also recognize they're not interested in any of the terms that the buyers or prospective buyers are presenting. So they typically, again, do not need a large payment. Therefore, they don't want a large down payment today because they would incur higher capital gains taxes. So in reality, what do most creative deals look like? They're actually a hybrid, okay? There are a good number of deals that have an under 10% equity position. There are only a few, relatively few, deals that have over a 90% equity position, which means the seller owns the home basically entirely in cash. But there is going to be quite a few deals that fall into this range, 10 to 50%. So as soon as our team starts recognizing the debt structure on the home, how much debt outstanding do they have? If it's a lot of debt, we go subject to, where they have less than 10% equity, meaning if it's $1 million home, they have $900,000 or more in outstanding debt. Seller finance, well, if the home is owned entirely in cash, like 90% or more, or close to, if not 100%, then yeah, seller finance definitely makes sense. Most deals will actually be hybrids. So what does a hybrid deal actually look like? A hybrid deal is going to be a blend of the two. So you are going to have a subject to takeover and some seller financing, and that's because we recognize that we can't necessarily give a seller 20 to 40% equity today. Why is that? Well, oftentimes, we could just go and get a conventional loan product for 20% down. And if a seller wants, in this scenario, 40%, it's like, hey, why don't you just find a conventional buyer? Okay. You might need a lot of today money. So this type of relationship and this type of structure with this type of deal might not make the most sense for you. So to finally clarify what makes sense for whom, let's talk about the seller's motivation. So in a seller finance deal, they want to avoid capital gains tax. So that means they're okay taking less today money because, again, remember, their avatar, they're very, very affluent. They don't need much today money. They're very, very well-to-do. They're likely retired and have enough to sustain their lifestyle already. Because they're okay taking that lower down payment, what they're going to want in exchange is a value slightly higher than fair market price. If I still have that drawing up here, remember, everything is about price and terms in real estate. You can't win on both. You can't drop the price and also say, hey, I'm not going to give you 100% of the total price today. If you're going to win on terms, which is what we want to do, I want a 10% entry or lower, which means I will have an amazing cash on cash return. If I buy a home in cash, my cash on cash is going to suck, right? If I buy a $950,000 home and put $950,000 in today, well, my cash flow on that property, because I might have zero debt, could be something like $60,000 a year. That's a 6% cash on cash return. That's not very, very good. I would rather get something like a 10, 15, or 20% cash on cash return. And I recognize that in exchange to do that, I kind of need to let the seller win on this, which is that price point, right? Like it's not even a, can't we get both? It's just like, dude, you have to give and take a little bit in this game. You can't just smash sellers, right? You can't do both. Nobody's going to work with you, okay? So this is fine because buyer's still winning exceptionally big. Your internal rate of return is another big item. It could be close to or well above 100%, depending upon your bonus depreciation structure, how much net effective tax savings you're getting back as soon as you close on the deal. And this, always going to be the best type of creative deal. There's one note. It's drafted between you and the seller, and it's a negotiable interest rate. You're in first position with the seller. Very, very infrequent that we get a pure seller finance deal. Most are going to be hybrids, right? So subject to, very, very important that we understand who is the avatar. So to close this out, a seller would want to do a seller finance transaction because they are very affluent and they want to cut capital gains tax. So again, very well-to-do, very affluent. Again, the more they receive today, the more they incur on capital gains. Now, a seller's motivation for a subject to transaction. So the seller is likely, again, some combination of they are very, very stuck in their position. And like we discussed, they might need to write an equity check just to sell the home. So this brings us to what is a motivation that a buyer would have and why would they want to do either deal type? Well, in literally all three scenarios, you get the blend of the three most important things. Total low entry, so that you can reduce your cash on cash. And then also a lower interest rate, which is a product of because you're taking over somebody's existing subject to mortgage, which should already be at a lower interest rate, or because you're negotiating seller finance terms, you're also increasing your cash on cash. And then what you're doing each time is also increasing your internal rate of return. And the best part is you are winning big on terms, so you should be okay with paying over slightly fair market value. Now, in a separate video, I break more down about how we find deals like this so that you can get the highest cash on cash return, highest internal rate of return, and thereby getting the highest amount of bonus depreciation, net effective tax savings for the lowest total entry into the deal. If you're doing deals like this on your own, you're probably putting 20 to 25% down and having crazy closing costs where you're paying a mortgage company or a lender a loan origination fee, which is literally tens of thousands of dollars, plus a buy down rate or a rate buy down where you're paying $8,000 to $32,000 just to shave your interest rate by a quarter point, half point, sometimes a full interest point. And what you could be doing instead is creative deals, and you could be having a team help you find deals like this every single month. So if you'd like our team's help, just click the link somewhere around the video. Check us out. We have hundreds of happy clients who are doing repeat deals with us every single year. And on our website, we have case studies, testimonials, and wins from them. So click the link somewhere around this video. Check out all that stuff on our website, and we hope to work with you soon.